Moving on, stocks mixed today with the Dow on track for another day of gains here. The headline for the economy is consumer sentiment. We know the preliminary report from this morning coming in much lower than economists had anticipated. For more, let's bring in Dan Skelly, Managing Director at Morgan Stanley Wealth Management. Dan, it is good to see you. So I got some more green on the screen today. The Dow here on track for its 8th winning session in a row. Dan, what do you make of this market and where do you think we go from here?
Sure, and thanks so much for having me on this afternoon. So what we would say is the sell-off that we saw since late March was really more of an adjustment sell-off, right? And you saw, frankly, a lot of the same leaders heading into the peak in March outperform during the sell-off, be it technology or energy or some of the others. And you actually saw some of the traditional and more yield-oriented sectors continue to lag. So again, this informed us that it wasn't so much a growth scare, it was more of an adjustment in the markets where the market, obviously, as everyone has talked about all week, continued to price out aggressive Fed cuts.
Aggressive Fed cuts, but that's not what we're hearing from the Fed, right? You know, you had a couple of other Fed speakers today who seem to indicate they're going to be quite patient. Do we believe that?
So, listen, I would say there's been, and our economics team led by Ellen Zentner has highlighted, there has been some notable surprises in the first couple of months of this year that we could actually see reversed in the next couple of months. So, namely, shelters and rents, we think might be on more of a disinflation path in the second half. We continue to see widespread penetration of immigrant labor, which is happening at lower wage clips on average. So we think the slowdown in wages that we've seen somewhat may continue. And then just lastly, goods seemingly continue to disinflate with China exporting deflation with all the excess capacity going on there. So look, I think there's some reasons to believe some of these surprises may reverse. Our official call at the moment is for still 3 cuts starting in September of this year.
Dan, I'm interested, as you look ahead here, what you think the next catalyst is for this market. Some are already looking ahead to Nvidia earnings. What do you think? How important is that print for the market?
So that's an excellent question. And I would argue a lot of the tee-up, if you will, for Nvidia has already been revealed because we just heard from all the big hyperscaler tech platforms over the last 2 weeks increase their capital spending. So the likelihood that Nvidia is going to at least meet, if not maybe even again exceed expectations, has been rising as all of the big tech players are saying, hey, we're spending more on these themes. Where else is that playing out? Very kind of nuanced in some of the power plays. You've seen utility, nuclear and gas plays start to see big earnings revisions because all of the big tech platforms are spending on data center infrastructure. This is all coalescing around the same theme you mentioned, which is NVIDIA's leadership in AI. So, yeah, I would say it's certainly a catalyst, but more to the point, we want to see overall earnings achievability. And as we've now printed 90% of S&P market cap weighted, the reality is we're on track for mid to high single digit earnings growth this year, which is kind of a slow grinding catalyst, but one that we think is still important amid all this uncertainty.
And when you're looking at where to deploy right now, would you rather play something like NVIDIA directly, or are you looking at that sort of AI adjacent ecosystem?
Yeah, another excellent question. And look, even looking at the first 4.5 months of this year, the Magnificent Seven from last year has narrowed into the Fab Four. And you're not seeing all of the same monolithic performance that you saw 18 months ago. So we've had exposure to NVIDIA. We continue to in the portfolio. But to your point, we are seeing this tremendous opportunity across other idiosyncratic ecosystem and infrastructure plays like power and potentially gas. We're seeing that also just in what we call the Fortune 100, the companies that are well-capitalized, quality names, frankly, across a host of industries, whether it be manufacturers, healthcare, financials. And to your question, this is where you're truly starting to see some players starting to kind of gradually adopt AI and starting to see some improvement in their earnings. Now, it hasn't been widespread just yet, but this is almost acting like a put option on the rest of the market because I think the general consensus is that more often than not, AI adoption is going to lead to better earnings power.
Dan, next week, we're going to hear from some retailers. I want to get you out of here on this, including the world's largest retailer, Walmart, a bellwether for the consumer. What is your general take there, Dan, on the consumer right now? Healthy, resilient, or showing some signs of cracks?
Yeah, I don't mean to punt on the question, but it's a mixed bag. And it's really a reflection of this phenomena of a two-track economy, where interest rates have really become the dividing line between the haves and the have-nots. This is playing out across, frankly, the corporate sector in terms of large versus small cap, companies that are strong balance sheet, net cash, and strong free cash flow versus unprofitable. And to your point, this is playing out very acutely in the consumer sector. And we've heard about this kind of, again, bifurcation among consumer spending trends in the last 3 weeks via earnings season in a way, frankly, I haven't seen as acute in years. And so if you just look at a handful of examples, whether it be restaurant spending and more rotation to food at home, whether it be the divergence between corporate travel with some expectations of Fed cuts, as we talked about, and potential M&A and deal flow versus domestic vacation spend, which was a completely kind of reopening revenge travel tailwind a couple of years ago, you're seeing this bifurcation in terms of the high end, the well-capitalized companies, and everyone else. And the question has always been, everyone's trying to figure out, is it a hard landing or a soft landing? The way I'm looking at it is more so in terms of this being an unknown flight path. Coming out of this pandemic with historic inflation and then aggressive Fed tightening, I don't think there is any playbook for this. But the one thing that we continue to look at is whether or not the one track can continue to hold up the overall averages. And I think there's some meaningful evidence that the second track is starting to drag things down overall pretty meaningfully. So this is something we continue to monitor closely.
Dan Skelly, thanks so much. Happy Friday.